Jai Hind. Welcome to GS NEXUS Current Affairs series. In today's session, we are going to talk about update on repo rate by RBI. Let's first know why this is in news. The Reserve Bank of India has announced a significant decision in its latest monetary policy review. The repo rate has been cut to 5.25%, while the reverse repo rate remains unchanged at 3.35%. Before understanding the impact, it's important to know the term basic points. One basic point is equal to 0.01%. So, a 25 basic points cut means 0.25%. Basic points are used to express small changes in interest rate or yields with precision. This is important in monetary policy where even tiny changes can impact loans, savings, bonds, and market sentiment. Now, let's understand what is the repo rate. The repo rate is the interest rate at which RBI lends short-term funds to commercial banks against government securities. It is one of the RBI's most important tools to regulate liquidity, control inflation, influence economic activity. When the RBI cuts the repo rate, borrowing becomes cheaper for banks. When it raises the repo rate, borrowing becomes expensive, reducing liquidity. Next is, what is the reverse repo rate? The reverse repo rate is the interest rate at which the RBI borrows funds from commercial banks. This helps the RBI absorb excess liquidity from the financial system. So, in this announcement, the reverse repo rate remains unchanged at 3.35%, showing the RBI's intent to maintain stability while easing credit. Now, let's know why has the RBI cut the repo rate. The policy stance appears accommodative, meaning the RBI is supporting growth. The major reasons include: first, slowing global growth; second, volatile commodity prices; third, US tariff hikes affecting Indian exports; and fourth is domestic demand requiring a boost. Next, let's understand the impact of the repo rate cut. First, lower borrowing cost. Commercial banks can borrow more cheaply from RBI. This encourages them to reduce interest rates on home loans, car loans, and business loans. Second is impact on FDs, that is fixed deposits. Banks usually reduce FD interest rates after a repo cut because their own cost of funds becomes cheaper. Third is boost to credit flow. Lower rates encourage more borrowing by businesses for investment and expansion. Consumers may also borrow more for housing, vehicles, and education. Fourth is push to real estate and infrastructure. With cheaper loans, real estate demand trends to rise. Infrastructure companies also benefit from easier financing conditions. And fifth is support from global uncertainties. An accommodative policy helps safeguard India's economy from external pressures such as US-led trade disruption, slowing global demand, and rising geopolitical tensions. So, in sum up, the repo rate cut to 5.25% is aimed at supporting growth, improving liquidity, and boosting sentiment across consumption and investment sectors. So remember, repo rate controls liquidity and reverse repo rate absorbs liquidity. That's all for today. For more such videos, stay tuned with GS NEXUS.